right, thanks folks. We're going to roll right into our next panel now. As I mentioned, this one focuses on addressing issues with financing higher education. This will be moderated by Kenny Morgan, our colleague at the Bipartisan Policy Center. He will offer a few quick opening remarks, introduce our other panelists, and we will get underway.
Thank you, Catherine, and thank you to all our panelists. I'm Kenny Megan. I direct BPC's Task Force on Higher Education Financing and Student Outcomes, which is being co-chaired by George Miller and Buck McKeon, two former chairmen of the Ed and Labor Committee. We also have several college presidents and other higher ed leaders on our task force, and we are coming out with preliminary recommendations in the next few weeks, so keep an eye on your inboxes, and we look forward to sharing them with you. As Catherine mentioned, this panel is going to be more forward-looking and assess the challenges facing student borrowers and how we can reform the federal loan system to promote better information for students, ensure that federal resources are going to students with the greatest needs, and lessen debt reliance writ large among the student population. We have a great panel today. To my immediate right, we have Doug Weber, Professor of Economics at Temple University and Fellow at BPC. We have Ashley Harrington, who is the Director of the Social Justice Program at the United Negro College Fund, which is the nation's largest minority education organization representing historically black colleges and universities. To her right, we have Kristen Fallon, who is the Vice President of Congressional Affairs and Director of Policy and Strategy at the Consumer Bankers Association, the only member-driven trade association focused exclusively on retail banking. And then finally, we have Rachel Fishman, who is the Deputy Director for Research at the Deputy Director for Research at the Education Policy Program of New America, which is a public policy think tank here in DC. So with that, let's get right into the questions. You know, the last panel talked about the $1.5 trillion in outstanding debt that we see today. This number's gone up exponentially over the past 10 years. It stood at 600 million, I believe, in 600 billion in 2006. So we've seen almost $1 trillion increase in the last decade. Doug, what's driving these trends?
Well, first, thank you so much for having me. There's, I think, two kind of big things. One is, of course, the cost, the price of college has gone up considerably, and there's many reasons that this has happened, and those reasons differ across sector. That state divestment certainly plays a part among public institutions, among selective privates. You're looking at maybe competition and trying to move up the U.S. News rankings. I think Baumol's cost disease, just kind of the notion that this sector relies heavily on labor inputs, and as long as that keeps being the case, it's when you're talking about highly educated labor that's gotten more expensive over time, that cost is going to be borne by colleges. So that's a big part of it. College costs more to attend, but then there's also that over the last several decades, colleges are educating a very different student than they were 10, 20, 30, 40 years ago. That it tends to be older students, a more diverse population, and this is wonderful. But there's tends to be fewer scholarships, and much of higher education is kind of stuck in the past in terms of funding the quote unquote traditional college student out of high school, and there's less aid available for what is the current student being educated, and so that that leads to more debt as well.
Do other panelists have any additional causes of the student debt portfolio, or do you agree with Doug?
So one thing that we look at is the New York Federal Reserve has come out with a study that says for every dollar of federal student aid, that can drive tuition prices up to at most 63 cents on that dollar. So I think the availability of federal funds is certainly something that also contributes to the increase in tuition prices.
So this is a really interesting point here. On the one hand, we've got increasing debt, which is caused by just rising tuition prices. But on the other hand, there's an argument that increased loan availability is actually driving up prices. Is it a combination of these two factors, or is one stronger than the other? Do we not know?
I'll let other people go first.
I mean, there's been a sense for a long time now, and you know, Education Secretary Bennett was the one who articulated this idea of a Bennett hypothesis, that it was the introduction of federal aid that has inflated tuition prices, and there's actually like very little evidence, I mean, in the ways that it's been looked at. So we know it's not really true for Pell. It looks slightly true for Pell when it comes to for-profit institutions. We also know that not a lot has been explored with the PLUS loan program. So student loans, especially at the undergraduate level, come with very strict annual lending limits and lifetime limits. But there are two programs in the federal portfolio that are basically unlimited loans, up to the full cost of attendance with no aggregate limits. And one is a loan program that is for undergraduate students who are dependent students, and it's made to their parents. So their parents are responsible for paying these loans back. And the other program is the Graduate Plus Loan Program. So this is really what has enabled graduate students to borrow unlimited amounts of money. And I think there, with this sort of unlimited money, I think the question of is it pushing tuitions up might be a little bit, might be muddying the waters a bit. But Doug would certainly know much better than I do.
Yeah, I'll just add, I agree with Rachel. I think it's just not clear enough from the data either way, but I think what is clear is that the way we are doing student loans in this country is not working, and it's not working for a large sector of our population, particularly people of color and low-income students. So I think focusing on that kind of masks the real question at issue, which is what is going on with how we create opportunity in this country and how we provide opportunity and who gets that opportunity. So it's less about whether loans are driving up costs, but actually who has access to what and for how much.
Kenny, if I go ahead.
No, go for it.
Sure, if I could just add on about what's driving this problem. That's something that we spend a lot of time talking about, and just to give you a little bit of background on why the Consumer Bankers Association cares about this space. So we represent the retail banking industry, and that includes the nation's largest private student lenders. Today, private student lending makes up about 8% of the overall $1.5 trillion market. So the federal government is absolutely dominating the space. Private loans are setting up their borrowers for successful outcomes. We've got a 98% repayment rate. Contrast that with what's going on in the federal space. It's vastly different. We've got 1 in 5 federal student loan borrowers who are seriously delinquent or default. So yes, let's talk about where the problem is and target our solutions to help those most in need. And we would say at the outset, you know, there's a role for the federal government, but the role for the federal government is to help those most in need and not those families that can access the private markets that have the financial ecosystem to succeed without the federal government helping them out in this regard. So we'd love to see solutions getting at what's driving the cost of college and how to help those that need the help the most.
That's a great segue to my next question, which is directed towards Ashley, and it's kind of a follow-up to your last comment on access and affordability. Where is the federal government falling short right now in terms of access and affordability, and how can we better target federal resources to traditionally underserved populations?
So I think they talked about this a lot in the last panel, but I think the most important step we can take is drastically increase the Pell Grant. The Pell Grant purchasing power has just been completely really just decreased since the program started. So we can drastically start by doubling the Pell Grant immediately, make it easier for people to fill out the FAFSA and actually access the Pell Grant, make it so that, if you already are participating in federal means-tested programs, we know that you automatically qualify for the Pell Grant, streamline the requirements. Also, UNCF, we always advocate that you support the schools that best serve low-income students and students of color already, and that is historically black colleges and universities and other MSIs. We take on a lion's share of educating and doing it well students that other institutions don't serve well. 70% of our students are Pell Grant eligible, 80% are African American, and we only represent 3% of all higher ed institutions, but we produce 17% of black graduates, 24% of black graduates in the STEM fields. And yet we have been historically underinvested in and undervalued at both the state and federal level. So if we want to really help students of color and low-income students, let's start here as well. Let's drastically increase the investment, not just in Pell Grants, but in the funding for HBCUs and MSIs.
One thing I'd say that's partially in response to the statement a moment ago about the lessening reliance on the federal loan program and more on the private markets. So much of higher education, I think it should better be thought of as, from a risk-return perspective, that on average, college is worth it. But there is, a lot of my work is focused on, the downside risk, that even if it's true that for the average person that you're going to, receive, earnings that are commensurate with your debt, the downside risk is absolutely there. And that's a really important thing and an avenue that, the federal government has, can play a really important role in, that, acting as a safety net, that private student loans, they don't have the safety net of something like income-based repayment. And as long as that's true, I think there really, needs to be a, continued role for, for the federal government, for, everyone, in terms of the loan program.
Can I respond?
Absolutely.
So again, there's a role for the federal government. It's to help those most in need. We believe that we're serving our borrowers extremely well with a 98% repayment rate. I think it speaks for itself. In terms of income-based repayment, I think that is an option on the federal program that should be targeted. It should be utilized for those in certain circumstances. Today, unfortunately, it's becoming the default. We've got over 50% of today's borrowers in income-based repayment. Only less than a quarter of those borrowers are actually paying down their loans today. So you've got about 75% of borrowers today who are paying $0 towards their federal student loan. So at the end of this income-based repayment program at 20 years or 25, depending on which of the programs you're in, we're going to offer borrowers forgiveness. So we're already seeing the tides start to change. We've seen a new CBO report saying that federal loans are now going to cost $31 billion over the next 10 years. That number's only going to increase at this rate. So I think IBR can be a good solution for a slim, portion of borrowers, but today it's being misused. So we've got to start thinking critically about how to set up borrowers for success. And I think a key piece of that is making sure that they don't overborrow. And I think you can improve it through loan disclosures. That's something that private student loans do very well at 3 times throughout the loan process. We're going to provide a very clear disclosure about what your loan costs are, what your monthly payment's going to be. Today, the federal government gives you dozens of pages of fine print and none of it's specific to you. So we're setting up borrowers for failure. And then just lastly, I think the PLUS loan programs, and I know Rachel's done a lot of work in this space. Today, so many borrowers are utilizing Parent Plus and Graduate Plus loans, and the outcomes are not great. We've seen huge enrollment in those programs, and I think that's really driving a lot of the loan balance increases. And those, there's no borrowing limit, really, except for the cost of attendance that a college or institution gets to choose today. So I think looking at those 2 areas would be great improvements.
I would like to dig a little deeper into the relationship between IDR and PLUS loans, particularly Grad Plus. What is it about? I think one of the panelists mentioned how potentially IDR and uncapped borrowing can lead to, has led to this excessive loan balances among certain students. Can you just talk a little bit about how IDR is designed and how it may be contributing to a lack of price discrimination, perhaps, and perhaps overborrowing, especially among graduate programs, if that's the case? Rachel, you want to take this?
I think it's really hard in the graduate space to really to understand fundamentally what's happening, because for all the data complaints that a lot of us on this panel have about the undergraduate space not having good outcomes data, there's literally zero outcomes data in graduate programs. We don't know what the return on investment for graduate programs are in terms of any sort of earnings data, especially when some of these graduate programs are very specifically tied to careers. Like when you go to law school, like most people assume they're going to be a lawyer when they come out, and that's going to come with a certain salary that's going to justify the fact that law schools cost like $70,000 a year times 3. We don't have any graduate, like how many people are graduating from these programs. And I think there's a general like anecdotal concern among some that perhaps a lot of master's degrees proliferated during the recession that were sort of these professional but terminal master's degrees that encouraged people to delay entering the labor market for another year because the labor market was, again, this is anecdotal because, again, we don't have good data about this and about the proliferation of these programs, but there's a sense of, a lot of people went right from undergrad to some sort of master's degree at their institution, thinking it would provide them, in 1 year I get a master's degree, I'll be more competitive in the workforce, but I'm spending another year in school. I have less to cover it because all of a sudden the Pell Grant's gone away. But it's okay because I can borrow grad plus loans and I know I can pay through income-driven repayment. So overall, we know the more education you have, especially if you have a bachelor's degree and above, which each level you get more of a return on investment in the data. But we don't really know what that looks like in the sense of giving, so it gives institutions a pass, right? Like if they're cross-subsidizing with these master's programs, it kind of gives institutions a pass while people are borrowing lots of money. And maybe they're not struggling to repay it as much as somebody who's only got an associate's degree or didn't achieve an associate's degree at all. We know the majority of struggling borrowers are struggling with $10,000 or less, not like the $100,000 borrower, but that's not to say that there's not some struggle going on. And that's not to say that we shouldn't be concerned about the high enrollment and income-driven repayment for graduate students and be calling for graduate outcomes.
So one thing that I'd say, just to start it off, I do think that, I'd say this is someone with a graduate degree who, teaches in our graduate program. I do think that there's, too many people going to graduate school in this country that just relative to what the labor market can bear. Now, I really want to push back on this notion that people are abusing something like income-driven repayment. That if you are I do think that there should be some reforms in how the formulas, not to get too wonky, but I think at the bottom end of income-driven repayment, I think it needs to be a little bit more progressive. At the top end, I think that there are, just because of the age earnings distribution and when people are earning money, and I think that there's too many people who are right now in line for forgiveness under IDR, but who are actually higher income people and will I think the formula absolutely should be tweaked, but and there are easy ways to do this, but I don't think that this is an issue of blame for the students in terms of misuse of IDR. If you're not making any payments under IDR right now, under on your student loans, then I think that suggests a role for accountability, that you did not get the return that you thought, and this is not a I don't think this is something that should be placed on students. I think this is something that we need to be tightening our accountability programs across all sectors, not just certainly people talk a lot about for-profit. I think I've done a lot of work and talked countless hours with Kenny here about ways that we can up our accountability, but that's to me, if there's that many people, and there are, that are not making progress on their loans, I don't want to put that on the students here.
I just want to add, I agree with a lot of what Doug said, and I think it also goes back to something that was mentioned on the last panel. IDR also currently doesn't adequately account for the difference between income and wealth, and how just because you make a certain amount of money a year doesn't mean you're actually able to do certain things that you would expect someone to do making that certain amount of money, because they have a different wealth background than someone else. And we know that wealth is also directly related to the historical context of this country, race, everything. So we can't just say there's a problem with IDR and the way we do IDR and the students that are using IDR. It's more than that, and it's all connected to the bigger picture. Is that a fire drill?
I think so.
Oh.
We're having a fire drill for those tuning in. We're on a fire drill for the folks tuning in online, so we apologize.